All right, a very good afternoon, everyone. So welcome to this panel discussion on the capital markets. So I'm Yang. I am most honored to be moderating this session. So joining us this afternoon, we have Christina, the CEO of Capital, Rush, the CEO for Asia Pacific at Allianz Real Estate, and Terence, the Managing Director, Capital Markets Asia at Colliers International. I do know that I will be widening the discussion beyond the shores of Singapore, given how connected we are with the region. And for those of you who have yet taken the poll, please log on to Slido, sli.do, and give us your views on the capital market. And you can also submit your questions to the panelists. And just as a reminder, please mute your mic when you're not speaking so as to reduce interference. So the latest data, as Scott mentioned earlier, the latest data from RCA showed the real estate investment volume in dollar value terms contracting some 50% in Asia Pacific in the first quarter of 2020. This is across all real assets except apartments and industrial. It is also a continuation of the 8% contraction that we saw for the whole of 2019. Terence, as the head of the investment team across Asia Pacific at Colliers, could you shed some light as to what is happening on the Asia Pacific investment front? What are the types of capital that's driving this recent activity? Is it more domestic, institutional, or is it cross-border?
Thank you, Dr. Chua. Yes, in 2019, we actually saw a contraction of investment activities across Asia Pacific. It's mainly due to the US-China trade conflicts, as well as, of course, the Hong Kong social unrest that all of us know. China and Hong Kong actually contributed to a major part of the contraction. And also at that time, yields were also substantially compressed in most key gateway markets. And investors were actually having a hard time looking for suitable investments. Well, in Q1 this year, everything changed. For Q1, it is a traditionally quiet quarter. But with the COVID-19 started to hit Asia, we started to see the investment decisions being held back and deals being withdrawn from the markets. Well, as we all know, the number in Asia Pac, based on RCA number, investment transaction volume actually contracted by some 50% as compared to Q1 last year, except for industrial, which actually contracted for just 8%, and the other sectors contracted between 30% to 60%, which is quite substantial. And in terms of markets, most markets contracted substantially at around 50% or more, except for Korea, Taiwan, and India, based on RCA data. Now, investors, at this point in time, is really unsure of course, we can hear more from Rush and Christina, but most of the investors I deal with are now very unsure of what is this crisis going to end up like. It's unprecedented, it's going to affect the economies. All the signs are pointing to a global recession this year, but how bad will it be? Though we saw governments introducing stimulus packages, but they are mainly to save jobs, to keep employment at a reasonable level, and not really to pump prime the economies for growth. And in fact, as all of us know, among the sectors being affected, hospitality and prime retail are the sectors that most badly affected, followed by student housing. For hospitality, it was actually a sudden shock to the sector, and this sector was actually doing very well over the last couple of years. Yields were compressed, values were achieving new highs. The COVID situation shocked the sector, is very badly affected with room rates, occupancy rate dropped substantially. And in some markets, we actually saw some hotels now asking for sale at 30% discount. And for prime retail, this another sector being affected, is already being affected by e-commerce in recent years with the change of format and how people do their retailing. And now with borders closing on cities, no tourist arrival, lockdown on cities, this sector is definitely very much adversely affected as well. Now, but the good news is on the extreme end of the spectrum, technology-related real estate, data centers, logistics, technology parks, business parks are actually pretty much least affected. In fact, there's a surge of demand now for data centers in China. And Chinese government is right now relaxing the regulation to accommodate developments in this sector. A case in point, APG, CCPIB recently joined venture with ESR to invest $1 billion in South Korea logistics, while Ivanhoe and Boeing Vest joint venture Logos to invest $800 million in China. And data centers, the latest news a week or so ago, GIC announced a joint venture with Equinix to invest $1 billion into Japan data centers. These deals were likely being entered into earlier this year, but they actually went ahead and closed the deals. And on your last question on the types of investors, cross-border investors actually form about a third of all the investors in Q1. But given the existing situation where we're restricted with travels, I think most of the deals or people are looking at the deals are only the domestic players. They are the only one who can transact in the shorter term, because with travel restrictions, you hinder the decision making for the cross-border players. So I wouldn't be surprised to see most buyers in Q2 and even Q3 will be more of domestic investors, while the cross-border investors will only creep back in Q4. That's all from me. Thank you, Dr. Chua.
Hey, thanks, Sharon. So indeed, the economic conditions is quite tiring right now, isn't it? So as countries continue to battle the pandemic with social distancing measures we've heard, the urban economy struggle with this fallout. We have heard about the continual loss in income for many occupiers, retailers especially, the suspension of trading in the UK property funds, and asset devaluation of European REITs as well as Australian funds. So Raj, Allianz's exposure to real estate across the globe, could you share with us your thoughts on these markets across Asia and Europe? Are investors, especially LPs, are they making any changes to their strategies?
Sure. Thank you for the question. First of all, I'm very happy to be changing out of my t-shirts and shorts and wearing a shirt. Maybe I should have put on a jacket like Terence did. But look, I think this is a fairly unprecedented situation, and the first thing that we've got to do is to make sure that we protect our tenants, and I think everybody is sort of in their own little ways are finding ways to support the tenants and their businesses. I think, and after that, one's got to make sure that the current portfolio is being navigated through this crisis appropriately. So I think a lot of us are spending time on understanding what is the impact on the portfolio and how to navigate through that, and finding ways to make sure that the impact is reduced as far as possible. Now, with regards to new investments, I think there is the first question is about the sectors. So far, it seems like residential for rent and logistics are relatively lesser impacted sectors relative to retail or hospitality. Office is a bit unknown. I think there is a split opinion with regards to how people may behave once we revert back to a normal situation. There are certain companies that have announced that they're going to have a permanent amount of staff working from home. That is particularly not easy because people need to have an infrastructure back home to be able to work from home. And then there are certain companies which are also thinking about having split offices so that they can have maintain social distancing in their current setup, and making sure they have a BCP plan on an ongoing basis versus having everybody in one office. So the verdict is still not out on office, and we will have to see once situation reverts back to normal. So I think for the time being, I think logistics and residential for rent look like relatively less impacted. Retail and hospitality are much more severely impacted. Student housing seems to have a short-term impact because of to understand travel restrictions are lifted. Does this structurally change the behavior of students and parents sending their kids outside to study? With regards to jurisdictions, I think US and Europe for the time being are in a lockdown phase. The lockdown is expected to be lifted in a phased manner in most of the countries in May. So we are hoping that activity slowly starts reverting to normal. In Asia, it's sort of a bit of a split. While China, Hong Kong, Australia seems to be reverting back to normal, Singapore and India are still sort of in a lockdown phase. So I think the activity is starting to pick up in China. I think the brokers are getting active now. We've started seeing deal flows. But I think it is within Asia Pacific, it's not impossible to do a transaction. We've been successful in closing a few transactions. I think the advisors and the brokers and the consultants are still working and are able to travel within a country or a city, and that allows business as usual. We've all going to accept the reality that we can't do the same level of due diligence we were able to do otherwise. I can't possibly go to Melbourne and see an asset at this point in time, but we've got to then rely on our partners and consultants to make sure that they are able to do the due diligence on our behalf. So I think it's unprecedented times. However, in case there is a transaction to be done, it's still possible to get the transaction done in the Asia Pacific region. And I think investors are slowly trying to pick up the transaction activities as things revert back to a more normal scenario.
Thank you, Raj. Indeed, this is very unusual circumstances we're in. It's kind of an amazing race to see which economy will open first. And on that note, congratulations, Christina, on your second closing of your infrastructure fund. During economic uncertainties like now that we're seeing, investors naturally seek shelter in structural trends such as rising middle income, urbanization, and assets with long WALE. And in this current dislocation, there has been a stronger leaning towards assets serving technology-related sectors, such as data centers and logistics, as well as social infrastructure, healthcare. Now, as a real asset investment manager, what are your thoughts on these emerging trends, especially in Asia Pacific going forward?
Okay, thanks, Yang, for the congratulatory note. I would say that actually the COVID, the speed of which it came about, unfolded, took us all by surprise. Some would say this is like a 100-year phenomenon where you have both COVID, pandemic, as well as a financial crisis all come together. I would agree with you. Actually, some of the trends that you have mentioned on the technology front, in terms of like the data centers, logistics, and healthcare, I think they will now be further accelerated. Take data center, for example. Even before COVID, we would say that data center is really known to be a mission critical center needed for data processing, data storage. And was very well demanded by the cloud players. But with COVID, I think this has further accelerated. What we thought digital transformation would take, expected to take years, have now become compressed within a matter of weeks and days where it's needed. So the demand for cloud services have soared. I would remember when COVID first started, all of us are hanging on, whether in office or at home, to our handphones, trying to figure out where's the next suspect case happening around, and watching over it very closely. And I think when governments actually in the world did the lockdown, most of, whether it's the young and the old, working from home, schooling from home, I would say that digital services are now the most important tool for business continuity. I think nobody would have even imagined at that time when you say that everyone will be working from home, schooling from home, all your video conferencing apps, whether Zoom, WebEx, Teams, and all that, online education portal, your online gaming, your streaming of Netflix and Disney Plus and all that would all come together, all deployed at one time. I think it's really quite a surprise for most, but now I think for most people, it's really a case of survival. The need for digital technology, the need for virtual facilities is critical. Like example today, ULI, if we don't have the digital facilities, we could not have this conference going on. So this is really a case right now for businesses. It's really in terms of survival, their relevance, as well as their productivity is all confined to the cloud space. I think with 5G as well, we would actually see there's a need for more capex to build more edge data centers as well. So the case for data center is really strong. Logistic, I think the world woke up one day to a surprise of this supply chain shock. I think people all over the world started queuing up, forming queues, hoarding consumable staples, whether it's food, beverages, and not forgetting our famous toilet paper roll as well. Couple as logistics center also have been activated by our Singapore government. It's deemed as an essential service. It's a very critical part of the ecosystem by our Singapore government. I cannot tell you what we keep for the population of Singapore, but it's logistics very important now. Then of course, healthcare. Actually, I think with COVID, it got magnified even further because there's this need for good social infrastructure, as some of the panelists have actually alluded to. I think going forward, the governments all over the world will be actually even more so pressurized to build good hospitals, testing centers, quarantine centers, and even such facilities where you allow for community care as well. To just round up and summarize, I would say that the push and demand for these sectors are very important, and it will continue. And not only in Asia Pacific, but I think globally you will see these trends. And I think what really sets players apart is whether you have the operational capabilities and the expertise and the track record. Yeah, thanks, Yang.
Right. Thanks, Chris. So just a reminder again, if you have any questions for our panelists, do submit them via Slido, looking at them. So while I wait for your questions, I'll just continue further. This question is for Raj and Terence. I think the elephant is in the room. We all know about interest rate, right? The question is, this interest rate is going to remain longer low for longer, now that the governments around the world is really priming the economies. What impact do you think will that have on investors, and how would yields trend? For context, the office yields tightened by about 70 to 350 basis points post-GFC across Asia. That's according to RCA data. So perhaps Aaron or Raj, you'd like to take this off first? Raj? Sorry, but I think...
Yeah, interest rate... Lower interest rate is one of the tools that the governments now have to combat COVID-19. So I think interest rates are expected to stay low over the short to medium term. Now, this should naturally, academically, this should help real estate because whenever interest rates are lower, cap rates tend to go lower. I don't expect that cap rates are going to compress from where they are today. But there is a certain amount of comfort looking at interest rates that cap rates may not expand drastically from where they are today. So I think we expect that in the short term, cap rates are likely to stay where they are or expand 10 to 25 basis point. It also again depends on the sector, but I think overall cap rates are expected to stay stable or maybe expand a little bit, and not because rates continue to tend lower and lower.
How about you, Terence? What is your thoughts?
I have a more drastic view from what Raj has just mentioned. Well, given the low interest rate environment, of course, we also understand that there's a lot of dry powder in the market. You know, in terms of global institutions, there are about 330 billion of capital waiting to be deployed. So with the liquidity, with the QE that's happening and this low interest rate environment, like what Raj was saying, it should cause yield compression as capital chase after deals. But interestingly, from my conversation with a lot of investors and looking at the different markets, this unprecedented crisis is actually creating a reset of the risk premium. So people are now looking at resetting risk premiums, yields, and they're trying to find their equilibrium level. So valuation of risk premiums are now, in fact, especially in the US, undeterminable in many cases. So yes, actually affecting credit availability for real estate debt. So in some of the deals that we are doing, there were some large deals in Japan that we are looking at. few $100 million funding deal, but the offshore US bank pull out of the deal because they can't value the credit. So this is affecting the market. So in the new normal, let's say after this COVID, how I see that investors will have to reprice risk. Investors will need to understand the new asset valuation in relation to the new valuation of risk premium by going through a price or a value discovery stage. Use of different asset classes will differentiate a lot more broadly as risk premiums distinguish asset classes with wider spreads. So only when you reach a stage when more and more investors go back to the market and start to compete for deals, then yields will start to tighten. But in the next 12 months or so, I think there will be a lot of uncertainty. But eventually, I think we'll see wider yield spread between different asset classes. Thank you.
Thanks, Terry. So kind of structural change to the market you can see. I have questions here. Just gonna down to one with the highest at this point. So what's our panelist view? What's the view on asset values in the event that social distancing measures are here to stay for long? That's assuming that there's no effective vaccine found for all coronavirus. That's the basis. So what's your view on the asset values in the event that social distancing measures remain here for long? Perhaps maybe we can have Chris, would you like to take that question off first?
Sure. So, Yang, just to be clear on the question, they are questioning on terms of what's the impact, is it? If social distancing stay here for a while.
Remain in place.
Yeah.
What do you think? What's your view on asset values? Yeah.
In terms of what asset values?
Values, that's right.
Impact to. Oh, okay. Actually, yeah, I know there are some questions just even earlier about whether office will be decimated and or concerned around that. My personal view is that it will not be. I think it could be a situation where people might actually look for Class A, Grade A office buildings instead, because this is a time where the employees' well-being are very important, and because of the care that people have put into talent base, salary costs actually far more than actually rental charges if you look at the P&L for any company. So because of the importance of this talent base, I think people will actually put a lot of effort in terms of making sure the employees are being employed and working in a place where there's clean air, there is actually very good operational capabilities by the office property managers, the office owners, to make sure that the filtration is there and all that. So I think there might be a move to actually your core Grade A offices, the impact of the stability will be there, more so than the other offices if they are not so as well built. Yeah.
Thank you.
Yeah, if I may, yeah. Look, I think when back in February, when we started looking at this, I think people were worried about the next 6 months. Now I think there is a possibility that this might go on for the next 24 months or 18 months. So I think what the focus is for investors like us is the income profile for the next 12 to 24 months. And I think if we can find a way to secure that income profile for the next 24 months, I think we would sort of still be confident, especially in Asia Pacific, in terms of the long-term potential of the markets that we operate in. So I think we still believe that China is a great place to invest for the long term. We still believe India is the same for India. I think Australia also offers you a long WALE. So I think if you can get over the hurdle of the first 24 months, I think the impact on valuation is, and I don't want to put a number to it, but it's still in everybody's head, is still a single-digit impact. Now, again, it depends on sectors. If you are in retail or hospitality, the perception is that people may not travel for a longer period of time, and there are people who are looking for deals. And so, if there is an eager seller, a buyer could sort of take advantage of that and price it at a bigger discount. But if you remove that demand supply imbalance, I think people are more concerned about securing income for the next 24 months, especially if the social distancing continues for the longer period of time, versus changing their belief in the long-term growth potential of Asia Pacific as a region. And I think the other advantage that Asia has vis-a-vis Europe or US is the diversity within the region, right? So I think if you have a portfolio which is well diversified across sector and across the markets in the region, you still have an advantage that while maybe China or India may behave in a particular way, Australia and Japan might behave in a different way, or Singapore behaves in a different way. So you do have that advantage of diversification in the region, and thereby I think if you construct a portfolio which is well diversified, the impact is relatively lesser than it would have been in a market which is completely homogeneous.
Thanks, Raj. Anything to add?
Sure. Yeah, I have something to add from an asset manager perspective. I think this social distancing measure will definitely affect the asset in two areas. One is the cost. Obviously, the cost of running a asset will goes up, right? Everything, you have to revamp the system. You have to make sure, more cleaning has to be done. That's for sure. So maintenance costs will go up. And secondly, the efficient use of the asset will also go down because of social distancing. You cannot, cram. It's like a co-working space. You put a lot of people in the one floor. You can't do that anymore. So the efficiency will be affected. The cost of maintaining will go up. That's my take on the asset management part.
All right, thank you, panelists. Well, just in the interest of time, we have a couple of more questions here, so I'm just going to read this through quickly. There's two very interesting ones on alternative assets. I think one of them again is for you, Christina. So, but feel free to add to anyone else here. One of the question is, what is your view on the future of private investments in foreign worker dormitory sector, as well as on the data center? Christina commented on the wholesale or retail or co-locations is better model in Asia. Is there country-specific versus global portfolio? Could you comment on that?
Okay. Okay. First on the second one, the data center first. Okay, in terms of the countries, I think people will actually like places like Singapore, Australia, Japan, and then China as well, because these are actually where the financial centers is, and where these are very well connected nodes in terms of the linkages, and now of course so people where all the hyper cloud players will actually group together as well. So that I think places like Singapore, Japan, Australia, Sydney, where all the international people are moving in, that's where people will congregate. I think for foreign workers dorm, I think the government will actually also play a part in looking after the welfare of the foreign workers. For Keppel, we have quite a number of foreign workers, but they are very well housed in proper dormitories where it's concrete built, so it's not steel-like structures where you will see in S11. Actually, the welfare of the workers are very well taken care of. So in terms of the problems that we are seeing right now, I think that's not as big a huge problem, a cluster. Yeah.
Josh,
yeah, look, I think everybody's got to understand that just because there is a COVID confirmed patient in a house or an apartment or an office doesn't mean that that space is not usable anymore. It's a simple cleaning exercise. So I think it should not change the attractiveness of a particular asset just because there is a COVID confirmed case. So I think people's got to understand that. And I think, again, the attractiveness changes based on liquidity and investor appetite and a bunch of other things, but not because there are more COVID confirmed cases in Singapore dormitories that nobody will invest in. And I think in terms of retail also, there is now a phenomenon called the revenge spending or revenge buying, where people are coming out of the lockdown and just spending more money than they would have otherwise spent. And we are seeing that, for example, in China, where we have investment in retail, that the average spend per person has gone up about 20 to 30% because people are coming out and just spending more. Even when I talk to my wife, I tell her that, I'm going to be once this gets over, I need to be on the road for 3 months and travel and not come back home. Okay. So I think there is a sense of sort of a human behavior, which is sort of now being called revenge buying or revenge spending, is that they want to all come out of this and do more of what they would have otherwise done. So I think that is a phenomenon that we don't know how to factor that in. Today the assumption is that people will travel less and people will not be spending on retail and going to malls. But you never know. Look, if there is a vaccine, the behavior might change completely, and people will travel and make up for the travel they haven't done for the last 1 year. So I think it's still unknown whether it's a U-shaped recovery or an L-shaped recovery or any other shape of recovery. So I think we are all operating in an uncertain environment, and I think the key is to sort of keep up to date and making sure that you are making decisions which are dynamic and real time versus sort of coming up with a plan which sort of fairly becomes obsolete very quickly because the situation is evolving.
Thanks. Gentlemen, kind of running out of time. But just one last word from everybody, literally one word. Any change of investor allocation to real estate, up or down? Starting perhaps with Terence.
Well, I will only represent but my clients, investors, that most of them will say definitely there will be revenge investing, because this crisis you see a lot of opportunities surfacing, so it's the time that long-term investors should invest now.
How about you, Rush? Up or down?
Yeah, look, I would just say more disciplined. Okay, so
Sorry, Krista, I cut you there. How about you, your thoughts? Up or down?
Yeah, actually, we will be continue to invest because we just had calls with Terence and his teammates as well in Asia to ask for where are the buying opportunities and looking for good buys, good assets. Yeah.
Coming soon.
Coming soon. Okay.
I'll
find you, Raj. I'll call you.
Thank you for being such great panelists and for allowing me to share this session.